Overview of corporate finance. Corporate finance is the area of finance dealing with the sources of funding, capital structure, and investment decisions made by corporations. It focuses on maximizing shareholder value through long-term and short-term financial planning and the implementation of various strategies. The core purpose of corporate finance is to create value for shareholders by making decisions that increase the firm's market value and sustainability. This involves choosing projects to invest in, determining how to raise capital, and managing risks effectively.
The role of the financial manager. The financial manager plays a critical role in managing a firm's finances. Responsibilities include investment decisions, capital budgeting, deciding which projects or assets the firm should invest in, financing decisions, determining the optimal mix of debt, equity, and internal financing, dividend decisions, deciding how much profit to distribute as dividends versus reinvesting, working capital management, managing short-term assets and liabilities to ensure liquidity. Goals of financial management. The primary financial goal is to maximize shareholder wealth, usually reflected by the market value of the company's shares. Other goals include profit maximization, increasing net income, but this can conflict with long-term shareholder wealth maximization, sustainability, ensuring the company's long-term viability, social responsibility, balancing profits with ethical and societal considerations. Maximizing shareholder wealth is generally considered the most comprehensive goal as it integrates risk, timing, and the magnitude of returns. Types of business organizations. 1.4.1 Sole proprietorship. Owned and operated by one person with unlimited liability. It is easy to form but limited in capital raising. 1.4.2 Partnership. Owned by two or more individuals. Can pool resources but partners share unlimited liability. 1.4.3 Corporation. A separate legal entity owned by shareholders. It offers limited liability and easier capital raising but is subject to double taxation. 1.4.4 Hybrid forms. Includes limited liability companies, LLCs, and S-corporations, combining benefits of partnerships and corporations. Types of business organizations. 1.4.1 Sole proprietorship. Owned and operated by one person, with unlimited liability. It is easy to form but limited in capital raising. 1.4.2 Partnership. Owned by two or more individuals. Can pool resources but partners share unlimited liability. 1.4.3 Corporation. A separate legal entity owned by shareholders. It offers limited liability and easier capital raising but is subject to double taxation. 1.4.4 Hybrid forms. Includes limited liability companies, LLCs, and S-corporations, combining benefits of partnerships and corporations. Financial markets and institutions. Financial markets where financial securities, stocks, bonds, are issued and traded. Primary market, where new securities are issued, IPOs. Secondary market, where existing securities are traded among investors. Financial institutions include banks, insurance companies, pension funds, and investment firms that facilitate the flow of funds. Time value of money, introductory concepts. The time value of money, TVM, is fundamental in corporate finance, reflecting the idea that a dollar today is worth more than a dollar in the future due to its potential earning capacity. Present value, PV, 0.000. The current value of future cash flows discounted at an appropriate rate. Future value, FV. The amount to which an investment grows over time. Understanding TVM is critical for valuing investments, loans, and any cash flows. Financial statements and their importance. 1.71 Income statement. Shows company revenues, expenses, and profit over a period. 1.7.2 Balance sheet. Displays assets, liabilities, and equity at a specific date. 1.7.3 Cash flow statement. Tracks cash inflows and outflows from operations, investing, and financing. These statements provide essential information for financial decision-making. The concept of risk and return. In corporate finance, risk is the uncertainty of returns, while return is the gain or loss on an investment. Risk-return trade-off. Higher potential returns usually require taking higher risks. Financial managers seek to balance risk and return to optimize firm value. Ethical considerations in corporate finance. Ethics in finance involves honesty, transparency, and fairness. Corporate scandals have emphasized the importance of ethical decision-making to maintain trust and long-term success. Summary. Module 1 introduces the fundamental concepts of corporate finance, the financial manager's role, and the importance of financial markets organizations and time value of money. These principles set the foundation for the subsequent modules that delve into valuation, capital budgeting, and financing decisions.